Hello guys, let's start our new topic. Today's topic is about cash flow forecasting and working capital. Let's start from cash flow forecasting. What's the meaning of cash flow forecasting? It is predicting the future cash inflows and outflows of a business. It shows the expected cash balance at the end of each month. Why are cost forecasts important? They are particularly important for three types of business: new firms, fast-growing firms, and firms with erratic sales. Based on market research so that they can plan ahead, fast-growing firms prepare to manage new volumes of cash inflow and outflow, maximize positive cash flow. Firms with erratic sales to help manage these months within that year that cash inflow may be low. Use of cash flow forecasts. Cash flow forecasts are useful in the following situations: starting up a business, running an existing business, keeping the bank manager informed, and managing cash flow. What's the meaning of positive and negative cash flow? A positive net cash flow is when total cash inflows are greater than total cash outflows. And a negative cash flow is when cash outflows are greater than cash inflows. The existence of any business depends on its positive cash flows. To avoid negative cash flows, it's always desirable to estimate or forecast future cash inflow and cash outflow. In this table, we can see the closing balance in May is negative, which means that it has become overdrawn. Look at this. What are the elements of a cash flow forecast? They are as follows. First one is receipts. Receipts are the predicted sales revenue for each month and also known as cash inflows. And payments are the money the business expects to spend during that time and also known as cash outflows. Net cash flow is the difference between the total payments and the receipts. Opening balance, the money that a firm has carried over from a previous month. Or in other words, each closing bank balance becomes the opening bank balance for the next month. Closing balance is the total of the net cash flow figure and the opening balance. And this is a formula of calculating closing balance. How to overcome negative cash flow? If the business knew in advance there is going to be a period of cash shortage, and it can take action to try to prevent this from happening. In case of negative balance of cash, business can delay some payment to have positive cash flow. If the business can't delay some payments by 2 months, it has two options. First one is use another source of finance like loan, and second one is as a shortage is forecasted to be for short term, the business may arrange an overdraft with bank to cover the shortage. There are several ways in which a short-term cash flow problem could be overcome. These are explained below. So first, let's start from first one. First one is to ask customers to pay more quickly for goods by offering discounts to customers who have been sold goods on credit. Second one is negotiate longer credit terms with suppliers. And last one is delay the purchase of non-current asset until the cash flow improves, increase bank loan or overdraft facility. How to improve cash flow? We can improve cash flow by reducing stock levels, increasing credits from suppliers, by reducing credit to customers, and by increasing sales revenue. In the longer term, a business with cash flow difficulties will have to take other decisions to solve the problem. This could include attracting new investors, cutting costs and increasing efficiency, developing new products that will attract more customers. And this is the activity from past paper of IGCSE examination, and I uploaded the scenario of this activity on Edu page, so please complete this cash flow forecast on the sheet provided using the information on Edu page. Next one is working capital. The term working capital refers to the amount of capital which is readily available to a business. That is, working capital is the difference between resources in cash or readily convertible into cash and the short-term debts, or in other words, current liabilities of the business. And all the business must have enough finance to pay for their day-to-day expenses, such as paying workers' wages and buying raw materials. Working capital measures the liquidity of business, and liquidity is the ability of business to pay its short-term debts. Business which doesn't have enough working capital will be illiquid, as it can't pay its short-term liabilities. And business may have to borrow the finance required. Business pay interest on the amount borrowed, and this increases their business fixed cost. It's all for today, and thank you for your attention, guys, and see you in our next lesson.